Okay, so good morning, everyone. Welcome to the macro snapshot. We are, what are we? Friday, January the 31st, last day of the month. So there could be some interesting sort of flows and whatnot. Okay, we've got quite a lot to get through, guys. So I'll go fairly quickly here. Okay, so yesterday we had the ECB. No surprises there. They cut 25 basis points. What is interesting, the takeaways were, I would say, if you remember yesterday, I spoke about a sort of a potential framework for looking at the European situation. They cut 25 basis points. I would say the tone overall was cautiously dovish. Dovish in the sense that Lagarde and the ECB seem to have a very strong sense that we're looking at the Bund chart here. So you see the German 10-year chart on the daily, you see it's going up. The basic idea of the ECB and Lagarde seems to be that they are confident that inflation will get down towards 2%, sometimes this year. When asked about service inflation and wage pressure, which I mentioned yesterday, Lagarde said that yes, it was a bit elevated, but they do believe that that's plateauing. It's reaching some kind of sort of top, and they believe that ultimately wage pressure will stabilize and actually decrease a little bit, and therefore service inflation will also plateau and maybe even decrease a little bit. So on the inflation front, they believe that that's sort of more or less getting towards a situation where it's under control. Secondly, on growth, I think this is the interesting thing. They were fairly cautious about growth. So I think, as I said yesterday, Europe was growing overall at about 1% GDP. And Germany was a little bit negative, but actually we just got before the meeting yesterday just some new numbers on GDP in Germany, which was a bit negative. Also, France was negative, and another country I forget as well. So definitely the GDP and growth seems to be slowing down, and it does seem to be at the forefront of the ECB's concerns. And so all that to say that they seem to be on a dovish path rather than worrying too much about inflation, which, as I say, they think's under control. They seem really to be focused on getting the baseline interest rates down so that that doesn't impede growth and actually might help growth a little bit. And in fact, Lagarde said several times during the press conference that she believed that they were still restrictive in this, and which is slightly dovish, because if you believe that you're restrictive and above neutral, that means that there's still more room to cut at this point because they're still being a little bit restrictive. In terms of the neutral rate, interesting for those who are interested, they said that on February the 7th, the ECB would release a document, a kind of like internal study about R star. So that's the rate of neutral, which is a difficult one, which is this idea of what is the interest rate, which is neither restricting the economy but is neither sort of loose and actively boosting the economy. It's kind of like the neutral rate is what they call R star. Anyway, so the ECB is releasing, as I said, a study on that on February the 7th in about a month. In about a week or so. So that's it. So a couple of other things, but all that to say that on the back of that, we can see here that the bunds. Also this morning we had some inflation data out of Germany, out of the provinces, the various states in Germany, which was on the soft side. So you can see here the bunds actually going up quite a lot. And if we look maybe at the 2-year, this is the 10-year bond. Let's have a look at the 2-year as well. So this is the Schatz. You see the Schatz having a big run up this morning. Then the Bobo. So all of the German bonds up a little bit. And let's see if they're supporting the US bonds just a smidgen as well. Maybe not a huge reaction. So on the back of all that, let's have a look at the euro. So we've got the euro dollar, the euro index, which, as you can see, this is against a basket of currencies, not just the US dollar. So this is the EXY. You can see that's down. We can actually see, if we look at the euro itself, look on the spot, we see spot euro also, it couldn't get back into that trade range, which we talked about, and looks as though it's maybe going to do a sort of a retest of the bottom here around about 102, something like that. Now, of course, a lot of this is also going to be dependent on the US dollar, which of course is going to be dependent on tariffs. So we need to talk about tariffs. Pretty simply, how can we frame this? A couple of days ago, at his confirmation hearing, the probable new Commerce Secretary in the U.S., a gentleman called Howard Lutnick, it was interesting because he said that tariffs on Canada and Mexico and may not have to be implemented if Canada and Mexico secure their borders, stop drugs coming in, and have tighter immigration. And so the market took that quite bullishly as thinking that Trump is just blustering. That was interesting. Of course, yesterday in the Oval Office, Trump again reiterated the famous deadline of February the 1st, which of course is tomorrow, which is Saturday. And Trump seemed to say, although he always says these things in a very casual and informal manner, but Trump yesterday said, no, we are going to put tariffs and he said 25% on Canada and Mexico, and he's working on China. Okay, so the market implications of that, of course, is that we saw, if we put this on, I'll put this on a 15-minute chart, and we can get a sense of some of the things going on here. So if we look at, let's say, USD CAD on the 15-minute chart on the cash, you can see yesterday here when he mentioned that it popped up and then it's given a little bit back and it's stabilizing. If we look at something like the, I think I've got the Mexican peso here on the futures. Yeah. So if you look at the Mexican peso, similar kind of situation that came off pretty hard. The other thing which is interesting to look at is oil because and you can see here again, you see this green spike here. This is the tariff headline here at 3:30, which came off, which has come back down now and is now kind of stabilizing at slightly lower levels. And the bottom line here about oil, well, we'll get to oil in a second, but the thing here is that personally, I think what's going to happen is that his advisors are probably trying to keep him calm. I think there could be a negotiating tactic whereby Trump tomorrow, as planned, does do a grandiose announcement, although he is signing some executive orders this afternoon at 3 p.m. So you never know. It could be that 3 p.m. he said he's going to have a executive orders ceremony. But it could be that tomorrow he institutes tariffs, 25%, which would be negative for CAD, be negative for emerging markets. But it could be, and there was a report in this morning's Wall Street Journal saying that there could be sort of a grace period before implementation, which would allow for negotiation. So you imagine the scenario, Trump will, with his big pen say something, oh, we're going to do tariffs of 25%. But in the small print, in the fine details, it could say, but this will be implemented, in 3 or 6 months, subject to review, blah, 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 blah. And that grace period of, who knows, maybe weeks, months, maybe a quarter, 2 quarters, would allow pressure to be put on Canada and Mexico and maybe China and the European Union. And there'd be probably some kind of compromise. So Trump that way could say that he's, the threat of tariffs, he could, declare victory on that. But the reality is that maybe tariffs would not be implemented for a series of weeks or even months, or maybe not at all. So it's complex. So it's a complex situation. Now, just in terms of the market, let's just go back to the daily chart here. Obviously, the countries which are directly affected, this is going to be probably a negative for the peso in Mexico. But of course, the reality is, if we actually just look at the chart here, if I can find the peso and all my currencies, where are they? Sorry, I got a lot of stuff here. Okay, so there's the peso and the futures. As you guys can see here, the peso has weakened a lot, in the last 6, 7, 8 months, approximately, what's that? Almost a quarter, about 22%. So yes, there's probably more downside, but at this point, you have to say that a lot of this has been priced in. Well, quite a lot has been priced in. And some of the stuff I've been reading is saying that, for example, in the example of Canada, the markets, one study I read said that, about 10% tariffs have sort of been priced in. The Bank of Canada issued a report on Wednesday, where they dealt at length about their modeling for this scenario. And they said that of about the 7% that CAD has fallen, about 6% of that could be attributable to a fear of tariffs. So, probably about 85, 90% priced in. But the point is, a 25% tariff would definitely hit the Canadian dollar and the peso here. And let's look at CAD. So we're looking at a CAD on the futures here. And you can see, it could definitely pop down to, let's say, the 68 cents or even, 67.5. So maybe another percent or 1.5% down. But that would probably be enough because, again, like the peso, the Canadian dollar has significantly lost value in the last, 3 or 4 months here. You're talking about, yes, about 7% or so. Okay, so that's that. Now, oil is an interesting one. Keep in mind, when we talk about oil, we have to be a bit more specific here and talk about WTI, West Texas Intermediate. So this is the grade which is shipped out of and priced out of Oklahoma, Cushing, Oklahoma. Already Canadian oil is trading at a very significant, West Canada Select trades at a very significant discount to WTI. But the point here is that Trump said that he hasn't yet decided about oil being tariffed. Keep in mind that about 4 million barrels per day, so 4 million barrels per day of West Canada Select goes down into the US, is exported into the US. So the point for refineries, because the US refineries are set up to process that heavy, sour, sort of heavy in sulfur kind of Canadian grade of oil. So the point here is Trump has an issue that if he does tariffs on everything coming in from Canada, including Canadian oil, effectively that'll be a 25% extra charge for US refiners, which presumably would be passed on to the US consumer and motorist um, in some degree, because not all of that oil obviously is used for gasoline. So that's a whole other question. But the optics are not great. And Trump, as we know, wants cheaper oil or cheaper energy. And so I think there's a reasonable degree that he would actually exempt Canadian oil. Now, just looking at the oil reaction yesterday, basically the WTI at least, that will go up if tariffs are imposed, and if tariffs are not imposed, that will probably just stabilize and we'll have other market factors. What I can say is that Canadian oil, any threat of tariffs, Canadian oil, I was looking this morning, West Canada Select actually went down quite a lot. So bad for Canada or Canadian oil producers, let's just put it that way. So that's kind of what's going on with tariffs. As I say, at 3 p.m., there's some kind of signing ceremony of executive orders by Trump. Who knows? Maybe the tariffs will be a part of that because he does like a splash, that man. On the other hand, it could be tomorrow. Now, in terms of the market, obviously, we'd have to be looking at the Canadian dollar and when the market, I'm saying Sunday when it opens, will be, and again on Monday morning. So we have the Canadian dollar, the peso. I would say emerging market currencies in general would obviously hate tariffs. Probably more to the point, though, trade-based currencies or trade-sensitive currencies, especially the Australian dollar, New Zealand dollar, and I'd say the euro as well are going to be hit, and also the Chinese renminbi. If we look at the offshore Chinese renminbi here, so the CNH, which I have here, you can see that whoops, you can see, well, actually, I bought a little bit of the US dollar against that. You can see here that that's come off, but it's setting up potentially to retest the lows here, which means up towards the 7.36, because obviously China, massive exporting nation, that would also feel the pressure of that. So all that to say, anything, if the tariffs are imposed, euro down, probably Chinese currencies down, the trade currencies like the Aussie, New Zealand, Canada down, peso down. But I'd also say in a general sense, probably emerging markets. So we'd have to look at, let's say, the ETF EEM, which I do believe I have here somewhere. Where is it? EEM. So let's say EEM. Again, that doesn't open until Monday morning. So it probably would gap up, but a gap down rather. So I think, definitely there's potential for EEM to get down to $42, $41, maybe even test down towards, something like this down to $40. So that definitely would be under pressure. I would imagine things like FXI, the Chinese large caps, would be under pressure. I would imagine, to be honest, that equity markets would be under pressure. Just because no one wants a trade war, so it's going to be kind of quite interesting. The question also would be, if Trump were to impose the tariffs, how fast will the market take to sort of read the fine print and understand that indeed there would be a grace period before implementation, and that the real risk of actually disrupting global trade is actually relatively minimal. So there's kind of quite a lot of moving parts. The other thing as well, which could be interesting, is the bond market reaction, because if we have a significant risk off kind of a reaction, at least for like 6 or 12 hours, could the bond market get a bid? Probably, possibly, but really the issue is that tariffs, by quite a few people's analysis, could in the medium term, maybe not the short term, but in the medium term, be in theoretically anyway, inflationary, which of course is not great for bonds, especially the long end. So maybe what we could see with bonds is maybe some kind of rally, like a risk-off rally, but maybe really led by the front end, on the idea that the long-term bonds are a little bit more sensitive to inflation. So we could get some kind of sort of basically sort of steepening kind of effect. I think we'll probably get a steepening kind of effect. Definitely one market or one instrument which is trading in an interesting way is gold. You guys will have noticed that gold is breaking out to new highs, no matter what currency you price it in. Let's look at the spot gold here, which I prefer rather than the futures sometimes. I mean, you see the futures here, but you have gaps because we have the future roll. But the futures are very much in new highs. But even on spot gold, so XAU USD, you can see that's breaking out to new highs. So we're currently trading at, what is it, about $2,800. Why is that? I mean, we have quite a strong US dollar. Yields have stabilized a little bit in the US, but yields are still at relatively elevated levels. I mean, we've got the 30-year here. Let's have a look at the 30-year yield. Still around about 4.75. I mean, it has come off from 5%. So one could argue that this stabilization and reduction in US Treasury yields has helped gold. We did have a little bit of, a bit of a pullback in the US dollar. But I think really the issue here is that apart from the constant bid by various global central banks. I think here the gold market, there's two things. There's the threat of tariffs and a possible trade war, and therefore trade tension, geopolitical tension. So there's some kind of safe haven element. But I think also there's the threat of tariffs does mean potentially disrupted supply chains and more inflation. So more inflationary environment, of course, is generally above a certain level beneficial for gold. So interesting to see here to see gold pushing up. Also seeing silver on the futures pushing up a lot. Some of this is also a little bit technical in the sense that this is the silver contract settled on COMEX, the New York exchange. Lady Grey this morning. Excellent. Touch of bergamot. Anyway, the point is that Trump has threatened tariffs also on metals, so especially precious metals like aluminium, but also silver and copper imports. And so the thing is that to physically deliver the copper or the silver based on the futures contracts at COMEX, there's a lack of supply. So there's huge imports happening now of physical silver and to a lesser degree copper into the New York exchanges, COMEX, which apparently is putting a little bit of a short squeeze here on silver. So interesting to see here if silver is following gold for geopolitical tension, safe haven reasons, inflation reasons, or if with some of these metals, including gold, there's a little bit of trying to front run potential tariffs on metal imports. That's an interesting one. If we look at copper, I mean, copper hasn't exactly joined the party. So that apparently was happening a couple of weeks ago, this kind of short squeeze here. Yeah, so interesting one there. So the other thing which I just want to mention overnight, guys, we had a bit of a rant by Trump. Again, we can't avoid his name on BRICS, Brazil, Russia, India, South Africa, sort of the developing nations, sort of non-aligned in a sense. Well, Russia's non-aligned. China, of course. Let's just say the non-sort of Western bloc. Um, there had been talk, maybe they were thinking of, at some point slowly trying to develop an alternate currency backed by gold and commodities. Trump yesterday sort of threatened BRICS nations that if they were to sort of come up with a new currency, there would be immediately 100% tariffs, 100% tariffs on any of their sort of exports. Putin's come out and said, hey, we're not thinking about doing that. But you see what's happening. Trump is really throwing around the tariff thing as a threat. So we shall see. Okay, just finally, guys, let's just have a look at the data today. We've got a bit of interesting data. We have PCE coming up at 8:30. Now, the thing is that can be, if you're a number cruncher, that can be understood by the CPI inputs and the PPI inputs. So that's kind of 95% known. So it shouldn't be too many surprises here. But what we can see here that year over year, still at 2.8, the core. So you see here, core PCE price index year over year, 2.8%. The Fed, this is the one the Fed looks at. And Powell, in his press conference the other day, did mention the year over year. He's basically saying, hey, we can't look at everything just every month. We're really trying to smooth it out and have a year over year kind of understanding of where inflation is. And 2.8% is still 80 basis points above their target. So it's not horrible. It's not 3 or 4%, but it's still definitely above target. And so you have to say that as long as this remains, let's say, above 2.5%, the Fed cannot get comfortable. So I think probably would have to see 2 or 3 months of this. I would say 2.5 or 2.4 for the Fed to start thinking about cutting again. That's the reality. But let's keep a look at it. The core month over month expected up a little bit at 0.2 from 0.1. So you see what's happening here is that, inflation is not exploding to the upside, but it's certainly remaining sticky. The other thing which actually I think could be more interesting in a sense, and perhaps even more important, is employment cost index, which is just a quarterly number, doesn't come out every month. And that's the totality of the cost an employer has to pay an employee. So it's not only the wages or salary, it's also insurance costs, healthcare, benefits, holidays, the totality of costs to employ someone. So it's quite an important metric. And Powell has said that, the Fed definitely looks at that. And again, as you see, that had been 0.8 the prior, now expected to tick up to 0.9. That's an interesting one. If that is, let's say, at 1%, that the bond market will not like it. On the other hand, if that comes in a softer, that could be beneficial for the bond market. Other thing to keep an eye on is personal income and spending and real personal spending. We saw that in the GDP numbers yesterday, relatively solid. The headline number was down a bit, but the personal consumption was pretty good. So let's keep an eye on that as well, just to see what's going on with the US consumer. So that's it, guys. We had Apple last night. Earnings seem to be, I had a kind of look at them. Earnings seem to be quite good, although there was softness in China and softness in iPhone sales. But it seems that on the call, there was sort of good news on services. So Apple has a lot of services now, sort of post-sale services, which is doing very well. So on balance, relatively sort of solid. We can actually just see how it's going in the pre-market here. Let me just put it in Apple. Here we go. So we see in the pre-market, yeah, it's up about $5 or so. So closed at 237.5, up at about 247. So up a few percent. So that's looking relatively solid. So at this point, the earnings have been relatively solid. We can look at the ES here. Just sort of technically, if you have a measured move, so ABC kind of Fibonacci extension, it looks as though it wants to retest the highs at 6150-ish on the futures, on the SPX, on the cash. Looks like it probably wants to retest the highs at 6130-ish. And of course, you see NASDAQ here up 78 basis points, even more than ES, and outperforming the Russell, which is a little bit weak. So I think it is month end, so some options expiries and various flows and rebalancing whatnot. But I think there's no reason why the market, I think, can't grind up. Although who knows, Friday afternoon, the risk of tariffs being imposed, maybe there could be a few chips taken off the table towards the close of the day. And at the end of the day, I think the market has become a little skeptical of Trump, which is possibly realistic in the sense that his bark is bigger than his bite. But on the other hand, if the market is too complacent, maybe there could be room for a short-term shock anyway, if he actually does decide, at least in theory, to impose 25% tariffs on Canada and Mexico, because really that could be seen as a precursor to more serious tariffs of 10% on China and the European Union. We shall see. Okay, guys, I'll leave it there. Have a great day and a great weekend. Take care. Thank you.